So this is now an update on the US dollar CAD trade, just to show you how it turned out. Now this trade was done in real time and it was based upon two factors. The first factor was that we noticed on this trade that when we put the 200 period moving average, the price had started to trade beneath the 200 period moving average, and as such I then started to draw trend lines on my chart. So I drew from this high to this high and projected down, and I copied that and put the same trend line there, and that gave me a channel, a rough guide as to the expected future movement of this market. Well, at this point here, when we pulled up to this channel, I had started to look for a trade, and I had assessed where would be my profit target. Well, the profit target was the bottom of the channel, which was about 140 points away, and my stop was placed above the secondary swing in this market, which is up here. So the potential was that I had about a 35 point stop for a potential target of 140 points, which is about a 3 to 1 risk to reward trade. So that's a very good risk reward level, and that's why that trade appealed to me. Well, you can see that the market makers were very effective in their strategy of actually wearing traders out. From the break of this high here to the actual real fall took somewhere in the region of about 45 hours. So that's 45 trading hours, which means that this market spent 2 days just wearing people out. And I've noticed that very often in the currency markets you get that sort of thing happening. Well, potentially we have another great trade coming to us as well. We can see the 200 period moving average is acting like a dynamic trend line, and this market seems to have actually turned over to the downside. Remember when I talked about this when we first looked at this trade, I wasn't sure whether was this just an A, B, C correction and the market would move higher. Well, the market makers were very close to actually triggering what would be buy orders above this position here, but they spiked to it but didn't actually take it out. Now if you'd been trading that, there is the possibility that you would have been pulled into that trade, because as the price comes up to this former resistance level, you'll find that sometimes they expand spread. So although you might have put an order above this high, what you'll find is as it came up there, they just blip spread 5 or 6 pips momentarily just to pull you into a buy trade, and they take your liquidity. So they wanted to sell, you wanted to buy, they closed you out and they took your order. And this is something that I've seen time and time again in the markets. The books that you read on trading are mostly wrong. They talk about putting your stop 1 or 2 pips below the previous low or above the previous high. That's absolutely fine when you have a strong trend, but in correction sideways markets like we have at the moment, you'll often find that you're just stopped out for no good reason. So when placing a stop, always give yourself enough distance, and in fact in the next video I'm just going to cover stop placement. Well, this trade worked out absolutely fine, and that is basically a trade built up from one simple principle, and that is trading in the direction of the trend. If price is above the 200 period moving average, look for long trades. If it's below the 200 period moving average, look for short trades. It doesn't get much easier than that. As a day trader, you need to always respect trend direction and look to only enter trades in the direction of a trend. Using a 200 period moving average will give you a quick snapshot of the trend direction of the market, and is an amazing tool and very simple. Well, I hope you enjoy this video, and in the next video I'm going to cover stop setting.